Hi everyone, welcome to another episode of Chat with Chen. We are going to be talking about a very special topic today. It's something that everybody talks about, yet nobody has a lot of information about. So we are going to be talking about how business owners build, preserve, and transfer their wealth in the most tax-efficient manner through succession and estate planning. We have a very special guest with us today. Her name is Sarah Balram. She's one of my professional partners. She's a certified financial planner and a certified financial divorce analyst. Sarah, welcome to the show.
Thanks for having me.
Yeah. Sarah, tell us a little bit about you.
Yeah, so I have a boutique financial planning firm and I have two arms of the business. So one of it is I work with business owners, professionals, and high net worth families. And essentially what we're doing there is basically helping them extract money tax-free.
Okay.
And paying less taxes overall. That's the goal for these individuals.
Absolutely.
For the business owner side, we're also helping them scale and grow their business because we are saving less on taxes.
Right.
On the divorce side of things, we have some business owners that are going through divorce, but also I help all individuals. And in that aspect of it, anyone going through divorce and separation, they don't have the tools and the resources in the financial family law world to determine if the offers that they're during the negotiation process is good for them. Are they going to be financially secure coming out of this? So I help them through financial projections and divorce financial planning to make informed decisions going out of this divorce. And so the post-planning that comes along with that.
Yeah, and that must be very, very important, right? I mean, I think, I don't know the stats exactly, but I hear 1 in 2 or 1 in 3.
It's about 40%.
40%
and
chances
60% of second divorces.
60% chances
60%.
of second divorces.
Yeah.
Wow.
Yeah.
And so I suppose that's also a side where a lot of people are not informed about, like, really, what are some of the choices or options that are available for them. And so you're literally able to guide them through the entire process as they sort of start their divorce process with their partner. Is that right?
Absolutely. And also the financial planning aspect of it is not a requirement in family law.
Gotcha.
And there's a lot of family law lawyers that don't know the services offered.
Got it.
And so I actually act independently and helping them make sure, like, I project, is this offer at what point is this offer going to make you go negative?
Got it.
And so they're able to help in the negotiation process.
Yeah.
It's phenomenal once they've actually seen, like, hey, we're actually thriving through divorce.
Gotcha. And I mean, it's usually a very difficult time just in general for all parties involved.
Yes.
And the fact that you're able to help navigate them through that process makes it much more easier for them to be able to digest. Because lawyers, I suppose, don't typically help you or look at that from a financial perspective.
No.
They look at it strictly from a legal perspective, and you're able to
Is it equal? Is it fair?
And you also have a bit of, I guess, legal background as well to some extent, so that you bring another dimension to the table just to be able to help them out.
It's actually a trio in the sense,
Yeah.
like, look, I've been in the space, I've worked in the space for about 6 years.
Right on.
I've actually gone through the experience myself, and then
Gotcha.
I have the education behind it. So
Got
you
it.
get the full trio there.
Amazing,
Yeah.
amazing. Awesome, but I know we're here today just because we want to talk about business owners and things that not everybody likes to talk about just because, for whatever reason. So we want to talk about business succession and estate planning and how that actually is a very vital component of a business owner's plan, or it should be.
Yes.
Yet it doesn't get talked about much at all.
No.
Why is that? Just based on your experience working with a lot of business owners, what is the primary reason on that?
It really boils down to two things that I've seen. A is just they don't have the time.
Yeah.
And by them not having the time, there's no one nagging them like, hey, this is important, this is important.
Yeah.
People usually leave them to drive that conversation.
Right.
So that's number one. And number two, it's just, you don't know what you don't know.
Right.
So they're also not aware that there's a problem or a potential issue.
Right.
So they're not seeking advice.
Yeah.
So I find there's that.
And just like, I know we work on many, many files together,
Yes.
and really having worked with a lot of business owners, one thing I noticed is that business owners just in general, they spend a lot of time and energy to build their business, grow it, cash flow it, scale it, do whatever it takes to grow the business. But the same amount of energy doesn't get put into protecting it, preserving it, and really transferring to the next generation. I say in a tax efficient manner because we really don't spend that time. So I know that's something that's super, super important, and that's one of the space that we really like to work in when it comes to estate planning or succession planning. So just because some people may not be aware of what estate planning or succession planning is, just at a very high level, like how would you define it? What is estate planning or succession planning when it comes to a business owner for you?
So for me, what I would describe it as is when an individual, like you're growing it for something, right? You're putting all your time, energy, resource into it. What do you want to do with it? Whether you want to exit, transfer, sell it, something, we're putting all this energy in because we want to do something with it.
Absolutely.
So to me, that's the estate and succession planning. What is the end goal? And helping you get there. And another, like, I know you saying like people are busy and stuff. The other conversation and the way I describe it to individuals is you kind of have an idea of the destination, because that's why we started in the first place. You know where you want to go.
Sure.
I'm going to provide you with the tools or the vehicle to get you there. You know kind of more or less the map. I'll probably give you a shortcut along the way or a more efficient way to get there. But I'm also looking out for your blind spots.
Amazing.
And there's no one really out there to tell you, hey, this is a potential blind spot.
Gotcha.
Yeah.
Which makes perfect sense, right? I mean, business owners in general, they just don't have the time of day to look for these things. And that's essentially why.
Or they've never been there.
Yeah, exactly. You don't know what you don't know at the end of the day.
So we're like, hey, this guy, he's 10 years out and he's had these issues. You're 3 years out. You may want to consider this, right?
Absolutely.
Whether it's the same industry or not, the plan or the framework is pretty much the same.
Yeah, and the best part about us is just working with some of our senior partners. The post-mortem learnings we learn from some of our larger clients or older clients helps us plan when we do the work with obviously the younger clients at the end of the day. So, so that being said, one of the things that always comes up is I know business owners just in general, they get a pretty decent tax rate, especially if your business qualifies as a small business deduction rate. Your tax rate is at 12.5%, but the same impact if you were to take that money out. Let's talk about, before we get into the succession part of it.
Correct.
But if you were to take the money out, on a personal basis, you end up paying a lot of taxes, and that's one thing business owners, hate a lot. Like they work really hard for their money, and they want to make sure they protect and preserve everything they can at the end of the day. Let's talk about some options. What are some certain things that business owners do to be able to access their money from the corporation to themselves, really in a tax efficient manner?
So tax efficiently, we'll talk about tax efficiently, but what I find is that the clients that are coming in, some of them are kind of not doing anything because they just don't know. Like they don't know, or they're afraid because we hear all the noise, right? They're afraid to take this money, put it somewhere someone's lost, etc. So there's that issue altogether. But on a tax efficient manner, I mean, there's dividends. We could take dividends from corporations, but again, you're being taxed there as well. The other thing is what we do essentially with ourselves. Also, you can invest, and there are some investments that, again, if you're investing, you can get dividends, so that's a preferred rate. You could do corporate dividends, that's a whole other conversation. But then we have the insurance part of it, which is like a newer conversation that individuals are kind of asking a lot more questions, because everyone's looking at, especially with the new real estate rules that are coming in, what are some other ways? So we'll talk about insurance and we'll dive into that a little bit more. Yeah,
absolutely, because you can do nothing with it. You have surplus cash sitting in the account, but if you don't do anything with it just because you don't want to take any actions, you're essentially losing purchasing power to inflation at that point, right? So you're eroding the value of that cash, whether you like it or not, just because it's just sitting there idle doing nothing. The second aspect of it is, you can take it out as dividend or salaries, but at the highest marginal tax bracket, 50%, 53% of what you take out goes towards CRA. If you want to help them out, sure, go ahead. But if not, and a lot of business owners don't want to do that, obviously, and so that becomes another hurdle. The third way you can do it, which, and as you alluded to, is you can invest within the corporation.
Yes.
But I think one of the challenges that we typically, talk about when it comes to investing within the corporation is that there are certain tax rules, doesn't necessarily favor passive income within the corporation, right? So can you elaborate on that a little bit more?
Yeah, so within the corporation, again, we can invest some of that money, but there are limits, right? And we know that the passive income limit right now is $50,000. And then anything above that affects your small business deduction. When it affects your small business deduction, you end up paying more taxes. You're not getting that nice 12% rate.
Right.
And so that becomes an issue. So then you're also stuck with a limit. And so you can only invest so much. Now, with that also comes with the way you're investing, what are you investing in? If you're getting interest income, again, tax, you're getting shot every single way. So being a tax efficient manner, we know and we have seen, and more individuals right now are looking at corporate life insurance.
Amazing. So Just to recap that part of it, so one of the most preferred rates for business owners, so small business owners, is that if their business qualifies as a small or is qualified to receive the small business deduction, they'll get that 12.5% or 12% in Ontario, which is obviously the most up to a limit of what, $500,000 typically.
500,000, yeah.
On the flip side, if you now invest, and that's on active business income.
Correct.
And now if you start to invest in passive assets that's generating passive income, whether it be fixed income securities or GICs, etc., any passive income you receive, you're going to get taxed at 50+% in Ontario. But in addition to that, once you start earning more than $50,000 of passive income, you're not only receiving a much higher tax rate on the passive income, but you're also starting to lose your ability to claim that small business deduction rate to a point where once you hit, I think, what is it, $150,000 of passive income completely, you're completely losing that 12% and you're now paying 26%. So you're paying passive income of 50% at the $150,000 of passive income. In addition to that, your $500,000 of investment in active income you're getting, you're now paying an additional 14% on it just because you decided to invest in it, obviously passive income. So you don't want to do anything with it. So that's an option out of the table. You can take it out at salary or dividend, but again, that's another option that's out of the table. You can invest it within the passive income or investments within the corporation. Yeah, there are certain preferred methods to do it sometimes.
There are, but again, we still need to watch out for those rules.
In general, passive income within a corporation is taxed at the highest marginal or highest tax rate in Canada. So that's out of the window. Another thing that typically comes up is, how do we now take that money out of that corporation, right? And one thing that I've seen is if business owners needed that money to fund their lifestyle today, meaning, hey, I need that money to go to the grocery tomorrow, whether there's a tax impact or not, they're going to take that money out because they needed to fund their lifestyle today.
And most business owners need to take a salary.
Exactly.
You need to.
Exactly.
We're talking more, and I guess the focus then would be for this conversation is what don't you need?
Exactly.
What are you going to do with the difference that's there?
And right before that, I know a lot of times shareholder loan is an option for business.
I was literally going to talk about that because that's what accountants are telling individuals.
Accountants talk about that all the time.
Well, look, we've seen, and I've seen that CRA is really cracking down on certain things. So there are those rules, and you need to, yes, it's fine to a certain extent.
Exactly.
You're not taking it to go on vacation. You're taking it for specific reasons, and there's the intent to repay.
Exactly. So yes, you can take the money out of that corporation through a shareholder loan, but there are specific timelines you got to pay the money back. There might be even prescribed interest rates that that you have to pay. But ultimately, it's not that you can take the money out of the corporation completely just through a shareholder loan, because you essentially have to pay that back. So that's another option that people think that's on the table.
Or if CRA decides that you're doing it for something else, they're going to put it as income. So guess what? Half of what you took is going to CRA.
It's now going to be taxable. And it's,
it just becomes a whole
so that's also
game.
So we've talked about 4 options, and all 4 options doesn't exactly get you the most preferred tax efficient way to take the money out. So now, okay, all right. So if they needed to fund their lifestyle, they're going to take it no matter what because they need to, right?
That's part of there. As they should.
Yeah. And so for a lot of business owners in general, the business they grow, it serves 2 purposes. If there's money in the corporation, as far as I know, is if one is that it's probably there to be able to fund their retirement to some extent, right? I mean, business owners don't get a pension plan or defined benefit or defined contributions plan. So they need to somehow fund their pension or their exits, their retirement through the business.
We're seeing that a lot with the professional side. So the doctors, the dentists, the lawyers.
That's something that obviously with there was a lot of chatter when the inclusion rate, capital gains inclusion rate was extended to 66%.
I feel like we could do a whole other chat about it.
Yeah, exactly. We didn't even want to get into capital gains, but of course.
Yes.
So one is that they want to be able to fund their retirement, no question. Or the second part of it is that they want to essentially pass those assets down to their next generation. They're building a lot of wealth. Ideally, they want to make sure they can essentially either give it to their kids or whoever they want to give it to. But if you don't end up planning for it, you'll end up maybe giving 50%, up to 50%, 60% to CRA as part of the process. I'm pretty sure if a business owner understood some of the impacts of these, tax legislations, they would probably do a little bit more planning.
100%.
But of course, it's just finding the time to get them to understand the tax impact that suits their particular scenario and then being able to work towards it at the end of the day, right? So that's what we want to do ideally with any business owners, any high net worth individuals, is just getting them to understand what are the tax and legal impacts, God forbid if something was to happen, because you don't want to work your butt off all these years only to realize a good chunk of that ends up with CRA.
Oh, and again, they just don't know.
Yeah.
There's no education component about it. And, you know, we work with great accountants, as you know.
Absolutely.
Accountants are
Absolutely.
focused on here and now.
Yeah.
And there's some that do the estate planning
Yeah.
and the tax planning, et cetera.
100%.
Mass majority of them that we found, because
Yeah.
we do a lot of files together, is that how do you pay less taxes today?
Exactly. Exactly.
But that's not necessarily a conversation for someone growing, who has wealth, who has an end
Yeah.
goal. Let's loop in that bigger conversation.
Exactly.
Yes, paying less taxes now, but how does that affect 10 years, 15? What is your end goal?
Yeah, and we talked about this just with the other day, because
Yeah.
everybody's focused on just a transactional activity to
Yes.
minimize taxes today.
Today.
Nobody wants to look at the bigger picture in terms of we can't do these activities in silos. We
No.
have to look at it from an overall integrated planning, which is not from a short-term perspective, but also from a long-term perspective, because this is what, especially after COVID, CRA is on the hunt to be able to crack down
Absolutely.
on many things. The last thing you want is to be blindsided by certain things without doing a lot of planning with your accountant and your legal team. So, Sarah, let's just dive down into one of the
Yeah.
items that we spoke about in terms of, now that we've said, hey, they don't need that money. Money is sitting in the corporation, it's just there. They need to do something with it so that they can eventually fund their retirement.
Correct.
And we've talked about a bunch of options, which is they can use any of these options, but ultimately they'll end up paying some taxes, right?
Correct.
And I'll never say the solution of corporate-owned life insurance is a be-all, end-all solution. It's never that
Never.
way. It's a complementary solution to maybe a variety of other solutions that are available to, obviously in the market space. But let's dive down and tell us a little bit more about corporate-owned life insurance and how that fits in from a retirement planning perspective for a business owner.
Right. So I'll just kind of explain how I would typically explain to any client,
Yeah.
right? So we've had this surplus, we know we want it to grow. We also know we want to access it while we're retired. People think when you talk about insurance that it's not for me,
Yeah.
it's for my beneficiaries, my
Yeah.
children when I'm not here.
Yeah.
So staying away from that conversation is usually what people do because they're just not aware of its use.
Yep.
So with the corporate life insurance, we have the surplus. We basically take it and we grow it tax deferred.
Yep.
So it's growing. We're not paying any taxes on it today. As with like interest income, you have to pay taxes right away when it's earned.
Yep.
It's growing tax deferred. Now, while it's growing tax deferred, it's able to grow bigger.
Yep.
We can access it. We can access it tax-free. Whereas with the other plans that we have, when you take it out directly, you have to pay taxes on it.
Yep.
There are special rules around accessing it tax-free. We'll do it through a loan.
Yep.
Now you have the choice. Do you want to pay it back or not? You have the ability and the flexibility to do so. So if you choose not to pay it back, that's fine. If you choose to pay back some of it, that's also fine. By having it formed in a life insurance, you have that added protection that we're not really thinking about, but the life insurance.
Right.
That's also growing.
Right.
Your estate is growing.
Absolutely.
So now when you're passing away, we'll service that debt, we'll pay that debt off, and then the difference will go to your beneficiaries.
Amazing.
And we'll do that in a tax efficient way through special tax accounts.
Yeah.
And individuals also need, when I show them and they're like, well, actually the money that's going back to your, first of all, the money that you have access to is more than you put in.
Yep. Absolutely.
So I'm giving you back all your money and then some,
Yeah.
substantially more.
Yeah.
But then we're also giving your beneficiaries large sums of money.
Absolutely.
So it's almost like when I explain to business owners and like I'm just explaining it in kind of like a
It's like
short
an aha
scenario,
moment.
there's no numbers
Yeah.
there. They're almost like, A, is this real?
Yeah.
And B, why is no one doing it? And
Exactly.
no one's doing it because it's not that there's not many, it's just that individuals or business owners are so busy that they're not sitting with people to tell them
To
what's
actually
available
hear about it.
to them.
Exactly. Exactly.
Yes.
So here's a solution or a strategy where you're able to grow your funds tax-free, especially through your corporate dollars, because any other investments that you typically invest within the corporation is usually taxable on a yearly basis.
Yes.
But here's a corporate-owned life insurance that you are able to grow on a tax-deferred basis within the corporation. The second part of it is when the business owners need to access it, especially during their retirement years, for example, they're able to collateralize it and use a leveraging facility
Yeah.
to be able to take all of that money out of their corporation to themselves without paying a lot of taxes at all, or without paying any taxes.
Correct.
Of course, there are ways to structure it properly, and that's one of the things we hear about is people think some advisors or clients alike, they might think this is just a regular transaction and let's process it. You want to make sure you structure these things properly. And then of course, and we also touched base on it, God forbid if something was to happen, you now, whereas if you didn't have something like this in place, when all of your assets, your corporate assets gets passed from your generation to the next, which is why there was a lot of uproar when the capital gains inclusion rate was increased, there would have been a huge tax implication. Now we are also able to minimize that, or even be able to make sure we are passing a lot of corporate assets to your beneficiary without paying a lot of taxes. So it seems like a win-win in many angles, obviously, right?
I call it my Swiss Army.
Yeah, absolutely.
Swiss Army knife, like that Swiss Army. There's so many things that you can do.
There's so many things that you can do with it. Absolutely. Something a lot of people don't talk about it, but here's a tool that is able to grow your money tax-free, access it tax-free, and then also be able to pass it down to the next generation in a completely tax-free manner. Something we talk about often. I always say people don't often realize it, but there might be about a couple of tools that are truly tax-free in Canada.
Yes.
We talk about it. What are the three things that are completely tax-free based on what you usually talk about?
So the ones that people are very aware of, the ones that are tax-free is your TFSA, and then there's your principal residence, and then now there's this corporate life insurance. And people are not aware that, so with the other two, your TFSA and your principal residence, well, the principal residence, you're almost like, your money's kind of stuck in there. So liquidity is an issue.
Yeah.
And if you want liquidity, you always have to qualify it through financial means. With the TFSA, there's limits. I like the corporate life insurance because there's no limit.
Yep.
There's no limit. Now, I mean, everyone's like, what's the catch? Well, we use the health for that, right?
Of course, of course. Yeah, so bottom line is, here's a tool that can help you grow your money tax-free and pass it down to the next generation tax-free. But whether you like it or not, there has to be an insurable need, and I know we are very clear about that. That's one thing. And second thing is, you might have the money to be able to pay for it,
100%.
but unless you have the health to be able to purchase it, you won't be able to qualify for these products. And that's why I always say, we don't want to do this or start talking about this when business owners are in their 60s or 70s. Yeah, there are other needs for them at that point. But when we are talking about these kind of solutions, when they're in their 30s, 40s, when they're growing their business, one, they're much more healthier, typically, right? Just in general, that's everybody, not just business owners. And typically, it's much more cost effective to be able to invest when you're much younger. So that's one thing that we love talking about. So just to recap, people often mistake the different tools that are available, but essentially in Canada, in my opinion, there are really three major types of tax-free tools. One is the principal residence, which is of course, you're able to grow your money tax-free and you're able to access it, pass it down to the next generation without paying a lot of taxes. There's the probate fee implication, etc.
Yes, of course.
But you're able to know capital gains, tax-free savings account, and the best kept secret, which is your a life insurance policy, which grows the money tax-free, and you're able to also pass it down in a tax-free manner, right? So that's great. But when we structure some of these policies, one of the things that always comes up, whether it's a life insurance policy or any other type of investment tools that a corporate owner typically wants to invest within the corporation, we sometimes talk about best practices. Maybe it's not always advisable to use your operating company to be able to invest these. What are some of the reasons that you usually talk about?
So holding company. So that's a conversation 101 that I have before we even go into, hey, this is the product, this is what it can do for you, this is the tool, this is how I use it. I try to get, again, where are we headed? What's the purpose?
Yeah.
And I try to structure things that are, first, tax efficient is important, but structure is more important than placing this tool in, because we don't want there to be creditor protection, like creditor issues later, right? Because now the estate, there are things that will pop up that, again, estate planning. It's nice to look at building, growing, but what are those blind spots that could potentially come? And creditor protection is one. So we look at a holding company as an option. Yeah,
absolutely, because we hear about this. I think it was a couple of clients ago when we worked on that one. It's just like, They had everything invested through the opco, and now they were actually being sued. And whether you like it or not, because there was no systematic, if you try to move that money out now, it's automatic. Obviously, you're trying to do that as part of a creditor exposure or like evading the creditors, and it's not going to be upheld in courts if you do that. So if you do, you're moving the assets out of your operating company to a holding company through an intercorporate tax-free dividend, and then you're able to invest it through the holding company. You're able to make sure you're, in case if there's a creditor exposure or a liability exposure, all of the assets you're growing is never impacted by it. Whether it's a corporate-owned life insurance policy or any other assets for that matter, at the end of the day, always have to, like, people don't pay attention to this because they're not thinking about it. They're not, and they may not be getting the right advice, but that's something that we always want to make sure that we're talking to anybody about, right? Perfect. So we kind of.
I guess I'm just going to interrupt you there a little bit as well, because I just want to add this because I think other people may be wondering. There's that conversation about trust as well. Trust. So whole other bargaining, but that's the conversation that we have as well. As well as I have Holdco, we have conversations about trust.
Absolutely.
I know people had that buzz about trust for a long time, and then now this capital gains rule, everyone's kind of like, should I do it? Should I not? There's so many different things in terms of structure that we look at. Is it right for you? Just because someone else did it doesn't mean that you need to do it.
And I think we always talk about this as well, right? I mean, when we look at estate planning as a whole, whether it's simple tools like wills and a power of attorney, or holding company for business owners, or secondary wills versus primary wills, we touch base on that a lot. We did. And then of course, a family trust or any type of trust that are available. It's always important to make sure we're not looking at everything just purely from a tax perspective. There should be holistic consideration that's always done as well, right? To your point, because we want to make sure that there's family consideration, just making sure you're being fair to people, or your beneficiaries at the end of the day. Everything cannot just take the lens of the angle of taxes. It has to be done from a very holistic perspective.
And I was just going to add on that where you said taking care of the family. Again, that's where my divorce expertise come in.
Absolutely.
Right? Because a good portion of this planning is probably going to go through the ringer. And making sure that it's nice to have a first family, a second family, but are we taking care of that first family?
Exactly.
Right? And so we see that a lot. So how do we reduce litigation in the future, and just being able to have all the expertise, and we work so much in collaboration. It's not one person doing everything. It's an expert in every field that clients don't have to worry about, am I getting the right advice? Am I getting holistic advice? And I think that's important.
Especially in a blended family situation, 100%. You never want
There's so many
miss
of them.
out. Yeah, exactly. You never want to miss out on the opportunity to make sure your children from a first marriage is taken care of when you're going through the process, just because you did this in void and it was done in silo and you didn't do a holistic planning, and it's very important, right? So Sarah, we've had a pretty good discussion about, hey, how do we grow the money tax-free? How are we able to access it tax-free within the corporation, or for the purpose of retirement or any other purposes? It doesn't always have to be for retirement purposes or exit strategy, but let's say 5 years of investing into something like a corporate-owned life insurance, you want to be able to grow the business and you need a business loan. You want to be able to extract the cash to be able to invest in, I don't know, equipment or manufacturing companies, manufacturing facilities, etc. You're able to use the loan from that cash value of that life, the money out of that TFSA or any other corporate non-registered investment. That asset is never growing.
It's gone.
In this type of scenario, a corporate-owned life insurance policy where you are leveraging obviously the cash value of that life insurance policy to invest into another asset if you want to, while the secondary asset is growing, your cash value life insurance 100%. Still continues to grow, just because we are obviously leveraging, collateralizing it, and leveraging, very similar to the equity in the home. So I always say the cash value is very similar to the equity versus the life insurance component of it. It's more so very similar to the sale price of a home at the end of the day, right? So always good to talk about that aspect. So we've talked about how to access the tax-free, but now let's talk about wealth transfer as a holistic approach, or a component of today's discussion, which is how do we actually transfer the wealth to the next generation, really in a tax-efficient manner as well.